Picture this carefully, because this is how banking stress actually enters ordinary life. Not through a dramatic trading floor collapse, not through a headline about derivatives, through payroll. You run a small business. Nothing exotic. Real invoices, real employees, real obligations due on Friday morning. Your operating cash sits at a bank you chose for sensible reasons. It is local, reputable, familiar. The branch manager knows your name. The institution sponsors community events. It feels close enough to trust. Then the downtown core begins to hollow out. The office towers are still standing, but the economics inside them are gone. Floors built for a different era sit half lit and half empty. Tenants shrink, sublease, or disappear. Valuations fall long before anyone says the word collapse. Refinancing windows close. Landlords miss the old assumptions by millions, and somewhere beneath that skyline, your bank is carrying those loans, not the giant institutions the public loves to blame. The smaller banks, the regional lenders, the community institutions that financed local office blocks, medical buildings, strip centers, parking structures, and the quiet commercial backbone of Main Street. When those assets stop producing enough income to support their debt, the problem does not stay in real estate. It migrates into bank capital, then into liquidity, then into access. That is the sequence that matters. In the next bank crisis, many people will discover too late that cash safety is not the same thing as bank familiarity. A solvent customer can still become an illiquid victim. By the end of this video, you will understand the mathematical failure sitting inside regional bank balance sheets, why commercial real estate is the trigger, and how to verify whether your money is protected before reassurance turns into restriction. The financial media still tends to frame empty office buildings as a property story. Falling valuations, troubled landlords, urban tax base pressure. That is all true, but it misses the more important transmission mechanism. This is a banking story operating on delayed recognition. The 2008 crisis was rooted in residential housing and securitized household credit. The weakness was pushed outward through mortgage-backed products, wholesale funding chains, and global counterparty exposure. This cycle is different in form, even if the psychology is familiar. The stress is concentrated in commercial real estate, especially office. And a meaningful share of that exposure sits not at the very top of the banking system, but lower down, where balance sheets are smaller. Funding is less diversified, and capital cushions are less forgiving. That distinction matters. A trillion-dollar institution can absorb pain differently than a local or regional lender, whose loan book is heavily tied to one geography, one property type, or one era's assumptions about work. When a community bank has large exposure to office, retail, multifamily, hospitality, or mixed-use projects in a stressed region, it is not managing an abstract market cycle. It is carrying concentrated claims on collateral that may no longer support the debt written against it. And here's the key mathematical break. Most of these loans were originated or refinanced during years of suppressed interest rates and much more optimistic occupancy assumptions. Buildings were underwritten on a world where tenants renewed, cap rates stayed tight, valuations held, and refinancing remained routine. That world has changed. Remote and hybrid work reduced demand for office space. Higher rates repriced debt. Insurance, maintenance, taxes, and tenant improvement costs climbed. So when a loan matures, the landlord is not simply facing an inconvenience. They are facing a refinancing event at a radically worse equation. A building that once barely worked at 3% debt now fails at 7 or 8%. Net operating income no longer covers debt service. The loan is no longer supported by cash flow. The collateral is no longer worth what the original underwriting assumed. What looks stable in a low-rate environment becomes impaired in a higher-rate one. That is why this is not just a property downturn. It is a balance sheet crisis with a time delay. The public sees the empty tower late. The bank sees the maturity wall later still. And depositors usually understand the danger last of all. By the time the problem becomes visible at the branch level, the forensic work was already done in silence, collateral marked by reality, loans rolled forward to avoid recognition, and equity quietly shrinking underneath the official language of stability. This is where the crisis moves from visible decay to accounting theater. A troubled commercial building does not automatically become a recognized bank loss the moment tenants leave or valuation collapses. Banks have strong incentives to avoid realizing that loss immediately, because once the asset is marked honestly, the damage moves straight into capital. So the first response is often not liquidation, it is extension. This is what the industry calls, quietly and politely, a loan modification. In practice, it often functions as extend and pretend. A landlord cannot refinance on normal terms because the building's income no longer supports the debt. The market value has fallen. New lenders demand more equity, lower proceeds, stricter covenanters, and higher rates. The borrower does not have the cash to fill the gap. The bank does not want the keys, so the loan is extended. Maturity is pushed outward. Terms are adjusted. The file remains alive. On paper, this can look manageable. In forensic reality, it often means the bank is buying time in the hope that rates fall, occupancy recovers, or someone else accepts yesterday's pricing. But time is not a cure for a building whose economics no longer work. Take a simple example. A downtown office property was financed when occupancy was strong and debt was cheap. Then tenants leave. Renewal rates drop. Leasing incentives rise. Net operating income falls from, say, $10 million to $6 million. At the same time, refinancing rates jump from 3% to 7%, 5%. The old loan was serviceable under the old world. The new loan is not serviceable under the new one. The debt service may rise just as income falls. That is not a cyclical inconvenience. It is a structural break. Now consider the bank's position. If it forecloses, it inherits an impaired building, operating costs, legal complexity, and a likely write-down. If it forces a market sale, the sale price may confirm that the collateral is worth far less than the loan balance. If it modifies and extends, it can postpone recognition and hope conditions improve. That is why distress can remain hidden long after the street-level damage is obvious. The building is economically dead before the loan is officially dead. The loan is officially stressed before the bank is publicly stressed. The bank is publicly stressed before depositors change behavior. The sequence is staggered, and that time lag is what makes the system so deceptive. This is also why the phrase performing loan can become dangerously misleading. A loan may still be current because the bank restructured it, granted interest relief, extended the term, or avoided forcing a reckoning. That does not mean the underlying asset has recovered. It may only mean the loss has not been fully admitted yet, and the clock keeps moving because every extension eventually reaches another maturity date. Every maturity date forces a new encounter with reality. If the building still cannot produce the income, still cannot attract tenants, and still cannot refinance at a supportable valuation, then the bank has not solved a problem. It has compounded an old one inside a thinner capital position. That is how rot spreads in banking systems. Not usually through one dramatic revelation, but through the repeated administrative postponement of losses that continue to worsen while everyone calls it stabilization. At this point, someone always offers the comforting solution. If offices no longer work, convert them into apartments. It sounds elegant. Empty towers become housing. Cities recover. Banks avoid deep losses. Everyone moves on, but most older office stock was not built to become homes, and that is where the fantasy breaks. A large share of office buildings from the 1970s, 1980s, and 1990s were designed around deep floor plates. That means the distance from the window line to the core is too large for ordinary residential layouts. Offices can tolerate broad interior spans under artificial light. Apartments cannot. Bedrooms and living spaces need light. ventilation, plumbing stacks, egress, and a layout people can actually inhabit. What works for cubicles and conference rooms often fails for kitchens and bathrooms. Then the financial reality arrives. Conversions are not cosmetic renovations. They are often near total reconstructions inside an existing shell. Mechanical systems, plumbing, elevators, fire code compliance, window systems, unit carving, acoustic separation, and structural changes can turn a repertoire story into a capital sink. Add permitting delays, zoning limits, asbestos, outdated utilities, and the carrying cost of the building during reconstruction, and the numbers collapse fast. Even when a conversion is technically possible, it may not be economically rational. And that matters because a false exit strategy can keep bad loans alive longer than they deserve. If lenders, borrowers, city officials, and investors all tell themselves that conversion will rescue the asset, they can justify another extension, another maturity push, another quarter without recognition. The narrative becomes part of the delay mechanism, but an office tower is not saved by being inconveniently adaptable in theory. It is saved only if the post-conversion economics justify the capital required. In many cases, they do not, so the building stays in limbo, not productive enough to support the old debt, not suitable enough to become housing at scale. Not worthless, but worth far less than the balance sheet implies. This is the kind of asset that traps smaller banks. It cannot be exited cleanly. It cannot be refinanced honestly. It cannot be repaired by optimism. And once enough of these properties accumulate inside one class of lender, the real issue is no longer urban design. It is whether the institution holding the paper has enough real equity left to absorb what those buildings are actually worth. This is the point where the discussion has to leave headlines and enter the balance sheet. A bank can survive bad loans. It cannot survive bad loans. Unrealized securities losses and deposit flight all at the same time if its common equity is too thin. That is the trap many smaller banks face. During the low-rate years, banks bought long-duration securities that looked safe on a credit basis. Treasuries, agency paper, mortgage-backed securities. The credit risk seemed low, but when interest rates rose rapidly, the market value of those holdings fell. If the bank does not sell them, those losses can remain unrealized. That sounds harmless until liquidity pressure forces a sale. Then the paper loss becomes a capital event. Now combine that with commercial real estate. On one side of the balance sheet, the bank is carrying office and other CRE loans that may be overstated relative to the real value of the collateral. On the other side, it may also be carrying securities purchased in a lower rate world that are worth less in the current one. If both sides are impaired, common equity becomes the shock absorber for two separate problems at once. And common equity is not a slogan. It is the thin layer standing between an institution and insolvency. Imagine a smaller regional bank with a loan book heavily tied to local commercial property. A wave of maturing office loans requires restructurings. Appraisals weaken. Risk ratings deteriorate. Meanwhile, large uninsured depositors begin shifting funds because they read the same headlines everyone else reads. To meet withdrawals, the bank needs liquidity. That may mean borrowing at higher cost, pledging collateral, or selling securities at a loss. Now the unrealized loss becomes realized precisely when carry stress is already eroding confidence. This is how a bank can look stable in slow motion and fail suddenly in real time. The public hears that capital ratios remain above minimums. What they often do not understand is that accounting categories, maturity assumptions, and delayed loan recognition can mask how little true room is left if multiple pressures hit together. A bank does not need every asset to fail. It only needs enough losses to pierce the equity cushion while depositors demand cash faster than management can manufacture confidence. That is why the phrase, "my bank is conservative," should never end the analysis. Conservative relative to what? Deposit mix? Duration risk? CRE concentration? Geographic exposure? Office exposure? Unrealized losses relative to common equity? None of those can be replaced by trust in a logo or a branch network. The real question is brutally simple. If the bank were forced to face reality on its assets while also meeting withdrawal demands, how much real capital would still be left? That is the question sophisticated depositors ask first. And it is the question ordinary businesses usually ask too late. So what actually survives a banking scare? Not confidence, not branding, not the phrase too small to matter or too local to fail. What survives is preparation against counterparty failure before the counterparty is forced to admit weakness. This is the audit. First, know your exposure. If your operating cash, reserves, and payroll all sit at one institution, you do not have cash management. You have single-point failure. Separate operating liquidity from reserve liquidity. Separate payroll from emergency cash. Do not build your entire business around one bank's continued normality. Second, know your insurance boundary. FDIC coverage is not a mood. It is a limit, and it applies by ownership category and account structure, not by your general sense that your money is in the bank. Many depositors discover this only after stress begins. Third, treat your bank like a borrower you are underwriting. Read its public filings. Look at commercial real estate concentration. Look at office exposure if disclosed. Compare unrealized losses to common equity. Look at the share of uninsured deposits. If you cannot understand the balance sheet, that is not proof of safety. It is proof that you are relying on trust. Fourth, diversify institutions, not just accounts. Wealthy operators do not ask whether one bank is good. They ask how many failure points can be removed from the system holding their cash. And finally, understand the difference between nominal wealth and usable money. A bank statement can show stability right up until access becomes the problem. That is the lesson history keeps repeating. Systems do not fail when the official story breaks. They fail when daily access breaks. The choice is simple. You can keep treating your bank as a utility and hope the hidden concentration never reaches your cash, or you can treat it as a counterparty. Audit the risk now and move before reassurance turns into restriction.